This video is about what happened on November 2nd, 2022 in regards to the target federal funds rate. As you've already learned, there are two entities who meet inside the Central Bank of the Federal Reserve in Washington, D.C., and that is the Board of Governors of the Federal Reserve System, as you can see the photo on the left, and also then the Federal Open Market Committee, which includes not only the 7 Board of Governors, but also required on this committee is the President of the New York Federal Reserve Bank, and then on a rotating basis every year, the remaining 11 bank presidents of the district banks throughout the United States sit on this committee. But what we're going to look at is what happened on November 2nd, 2022, as far as the press releases that the Federal Open Market Committee first came out with, and then the monetary policy that the Board of Governors is going to initiate to help target the federal funds rate. First, let's look at the press release of the Federal Open Market Committee statements made on November 2nd, 2022. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 3.75 to 4%. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Once the FOMC sets the target range in which the federal funds rate should fall between, the Board of Governors of the Federal Reserve System voted unanimously to raise the interest rate paid on reserve balances to 3.9% effective November 3rd, 2022. So as you can tell here, the Board of Governors sets the interest rate on reserves or on reserve balances, and it sets it between that rate of 3.75 to 4%. Now, as you can tell, in a related action, the Board of Governors of the Federal Reserve System voted unanimously to approve a 0.75 percentage point increase in the primary credit rate to 4% effective November 3rd, 2022. So as you can tell, the interest rate on reserves or reserve balances went up 0.75 percentage point or 75 basis points, and the primary credit rate also was raised 0.75 percentage point or 75 basis points. So you can tell, as the primary tool that the Board of Governors uses to initiate monetary policy is the payment on interest on reserve balances or payment on interest on reserves, and the primary credit rate, which used to be called the discount rate up until 2003, it is now really the discount window's primary credit rate will go up on November 3rd, 0.75 percentage point, just like the interest on reserve balances went up 0.75 percentage point. The two administered rates of the Federal Reserve are the interest rate on reserve balances, or IOR. The other administered interest rate is what's called the primary credit rate, which used to be called the discount rate, or 0.1% above the interest rate on reserve balances. When the Fed uses its primary tool, interest rate on reserve balances, This is done by the Board of Governors, and then the discount rate stays a certain percentage above that rate. So let's look at March of 2022. It's when the Fed changes the interest rate on reserve balances, then both that rate plus the discount window's primary credit rate also rise. And if you notice, it rose here in April 0.10%. So let's just look throughout this whole few months here. If you notice, the difference between the interest rate on reserve balances and discount window primary credit rate is 0.10, and that happens every single time that the Fed raises the interest rate on reserve balances. Notice it's still 0.10. But what's most important is that the Fed, when it raises the interest on reserve balances, which that is the primary tool of U.S. monetary policy, then this brings the effective federal funds rate up, which is really a short-term interest rate. But it remains below the interest rate on reserve balances. Now, this is important when we look at the second graph. On this graph, you notice we have the interest on reserves. It brings up the federal funds rate. So as interest on reserve balances rises, so does the federal funds rate. What this does in turn is it has a propensity to pull up the interest on 30-year fixed mortgage rates, which are considered to be long-term rates. So what the Federal Reserve's trying to do is raise short-term rates, which is the federal funds rate, which in turn has a propensity of increasing long-term rates, whether it be 30-year fixed rate mortgages, whether it be other long-term rates. Now, this then is going to affect consumption and investment, and as you well know, this will affect aggregate demand. So let's get to those graphs now. Notice what we've been talking about is we've been talking about the primary credit rate, and the interest on reserves are the administered rates of the Board of Governors of the Federal Reserve. Now realize that the distance between here and here right now is 0.10%, and that the federal funds rate stays relatively close to this interest on reserves, which is the primary tool used by the Federal Reserve. Looking at the graph on the right, you can tell that this economy is in what's called an inflationary gap. What that means is that aggregate demand has shifted to the right, increasing real GDP and driving the price level up. The Federal Reserve is concerned that aggregate demand will shift farther to the right, increasing this inflationary gap. To slow this economy down then, in other words, they want to bring aggregate demand back down to its equilibrium at full employment. To do this, the Federal Reserve raised the interest on reserves 0.75% or 75 basis points, and then obviously that raises the primary credit rate, formerly known as the discount rate, up also. So as that moves up, that tends to pull this policy rate of the federal funds rate upward, which then in turn increases long-term rates. And as long-term rates go up, then consumption and investment will decrease, causing aggregate demand to shift to the left, bringing the price level down, bringing employment down, bringing real GDP down, but increasing unemployment. This is the fear that people have about us possibly going into a recession. We won't know that for a few to several months down the road. But hopefully this lesson that I presented on video will help you to understand better how the Board of Governors determines the administered rates of the interest on reserves, which is the primary tool used by the Board of Governors, and the primary credit rate just floats along in the same direction unless the Board of Governors decides to narrow this gap during financial crisis time and wants to add liquidity to the market. You won't have to know that for the AP exam. Just know as they begin to raise this, the reason that they're doing that is they're fearful that aggregate demand will keep picking up, and what they want to do is decrease aggregate demand by decreasing consumption and investment, by raising those short-term rates, which raises long-term rates, which causes consumption and investment to go down. Hopefully this has helped you out a little bit.